Well, welcome everybody. We are very excited about today's panel. It's going to be a very different and unique panel. I'm really excited to guide all of you through it. My name is Lisa Feria. I'm the managing partner and CEO of Straight Out Capital. And I am joined today by some amazing contributors to the ESG space. And I think you will be very inspired and informed after you finish today's panel. And it's actually a mix, so we'll talk about that. It's panel/presentation. So the panelists, and they'll introduce themselves a little bit later on, but I'll just mention their names and their titles here. We have Jed Lynch, Head of America Sustainable and Impact Banking, Barclays Investment Banking. We have Juan Aguiriano, Head of Sustainability Technology Ventures, Kerry Group. And we actually have Maria Lettini, which is the head of FAIRR, amazing nonprofit that you're going to hear more about it in the presentation, doing really great work in this space. So the panel will be between 40 and 45 minutes, and you'll get 15 minutes at the end to ask questions, but feel free to use the chat box here if you want to have any questions that you want us to incorporate at the end. And then we'll move into two very interesting and intriguing presentations, one given by Joe Raven, Senior Manager, Research and Engagement at the FAIRR Initiative, and the second one by Devon Bonney, Analyst and SASB Standards Food and Beverage Sector Lead, Value Reporting Foundation. So it's two really very interesting presentations. I think you'll be as fascinated as I was when I saw them. All right, next slide, please. Couple participation guidelines. If you've been at different panels at GFI, the wonderful GFI conference, you've already heard some of these, but we'll go through them. Be present and engage, practice active listening. It's really hard to get distracted when we're all doing this virtually. So please, the panelists have taken from their, and presenters, from their very busy lives to share their knowledge and expertise with you. So please be engaged and present. Speak courteously. That should be always what we all do. And participate in the chat. Not all comments we can respond to, but we will record and acknowledge all comments. And many times the presenters will, after seeing your comments, will adjust their answers and just kind of answer your questions as they're speaking. I will point your attention here at the notes. So if you do things that are not nice, attacking or intimidating, that you will be kicked out. So just FYI. And of course, if you experience technical difficulties, which half of us experience just trying to get on the panel, please exit the session, go to the Expo tab, and then the help desk will be able to help you, or restart your computer, which is what I had to do. All right. Well, without further ado, I will have the presenters introduce themselves. Why don't we start? Juan, we'll start with you, then Maria, and then Jed.
Thanks, Lisa. So I'm Juan Aguiriano. I'm the head sustainability globally for the Kerry Group. I also lead our technology ventures, scoping and investment. I'm very happy to be here today. I've had the pleasure to work previously with FAIRR and Barclays, so it's fun to partner on this panel with you guys. And GFI for us is a very strong partner. So, look, I'll keep this introduction short, and then we can talk about what we do at Kerry afterwards. Lisa, back to you.
Sounds good. Maria, do you want to go next?
Yes, thank you. Delighted to be here. Thank you very much for the invitation. My name is Maria Lettini. I'm obviously not Jeremy Collar. I'm the executive director of the FAIRR Initiative, obviously working very closely with Jeremy, who's our founder and chair. The FAIRR Initiative, just quickly for those of you who don't know, is an institutional investor network. We are a free membership network. We have over now 280 institutional investor members whose assets total over 40 trillion of AUM. We produce research and practical tools for investors to understand the risks associated with intensive animal agriculture, as well as the opportunities afforded by a transition to plant-based alternatives. Again, very happy to be here, and I'll keep it short. Thanks, Lisa.
Yeah, and I'll just kind of round it out quickly. Again, I'd start by saying thank you to GFI and fellow panelists. Excited to be a part of this and to be invited to speak. So my name is Jed Lynch. I'm managing director at Barclays. I sit in our investment bank. And I lead a group that's called Sustainable Impact Banking. So it's an interesting team and initiative. I think it's a reflection of some of the themes we're going to touch upon in this panel. But my focus is around sustainability, but from two perspectives. One is identifying companies that are using technology to have a positive impact and give them advice on how to grow and scale. And so alternative protein generates positive impact on a couple different layers that we can go through. And then the other piece of that platform is trying to really get to know and spend time with ESG investors and impact investors and understand their strategies and their objectives, and ultimately trying to connect these companies that are making that impact with the investors that are looking to support those businesses. So sitting at kind of the intersection of a lot of these themes from an advisory perspective.
All right, thanks, Jed. So I thought before we start the questions that we should take a few seconds to define ESG, because I know that a lot of us have different ideas about what it might mean. And I want to make sure that we take a few seconds before we start asking very specific questions about how all three of you look at ESGs to actually define it. So I'm going to read what I found online and that I think is an actual true, pretty thorough definition of ESG. Environmental, social, and corporate governance. Those are the three factors. And that measures the sustainability and societal impact of an investment in a company or business. Analysis of these criteria is thought by some to help better determine the future financial performance of companies, both return and risk. The environmental factor covers how business performs as a steward of our natural environment. And that focuses on waste, pollution, resource depletion, greenhouse gases, etc. The social criteria looks at how companies treat people and concentrates on employee relations and diversity, working conditions, local communities, particularly institutions that serve poor and underserved communities, health and safety. And finally, governance examines how a corporation polices itself, how companies govern, and focuses on tax strategy, executive pay, donations and political lobbying, corruption and bribery, and board diversity and structure. So keeping that in mind, I would love to ask the panel your view on why alternative proteins should be considered in investors' ESG and impact investment strategies, and/or in firms' corporate and social responsibility strategies, especially carbon emissions reduction goals. Maria, why don't we go with you, and then Juan, and then Jed?
Yeah, sure. Well, I mean, let me just start by saying, investors by default are looking at risks and opportunities across all sectors and all asset classes, right? So to give an example, I mean, we've just lived through the period of COVID where a lot of these risks were really brought to the fore, particularly those that were associated with the food system. So besides pandemic risk, there's, which has a number of other risks inherently sort of baked in, like biodiversity loss, climate, waste pollution, water usage. I think the pandemic also really drove home the fragility and the lack of resilience in the animal protein sector, right? So when the US meat supply chain was broken and the meat shelves were empty, the plant-based meat alternatives were still available, right? And when the meat companies had to cull animals and pour milk down the drain, this was an enormous hit to their bottom lines, and also a huge red flag to investors about the environmental and social risks of their investments in meat processors. And then, additionally, when China was hit with African swine fever and alternative proteins like omnipork and others flourished, and egg prices years back, really got hit hard and prices surged, and there was an egg shortage, many companies moved to egg-free mayo. So, that combined with this understanding that now companies who are not ahead of the curve, for example, I mean, again, we've probably heard all of these examples like Borden and Dean Foods going bankrupt for not foreseeing the writing on the wall about plant-based milk. Investors start to take note, right? And those are real seminal moments in the industry. And frankly, we're now at another pivotal moment that we're addressing climate and the impact of this industry has on our ability to meet emissions targets, right? So all of these sort of ESG moments, or all, how you very nicely outlined, are actually turning into real events that are affecting the profitability and the outlook for these companies. So, essentially, we have no alternative but to look at the food system and think about why investors should be considering alternative proteins when we've already seen how disruptive, certain sort of tail events can be in our current food system today. Sure, Jed had some really good examples as well with things that have hit home with his clients.
So we are on the side of the industry, right? And for us, if the audience doesn't know who Kerry is, we're a 7 billion revenue company, B2B mostly. 90% of what we do is ingredients. We have 26,000 employees. We operate in 150 countries. We have a very large number of manufacturing sites, assets, and customers. We sit in an interesting place in the value chain, right? Our customers are the big consumer goods or startups that produce packaged food into retail, into food service. We have a very large business in both developing markets and emerging markets. So we're very diversified, and our suppliers will be the big feedstock companies that buy from the farmers, etc. Right? So we convert basic raw materials and ingredients into high-value solutions that provide taste, nutrition, and nowadays they also provide sustainability. What does sustainability mean? Well, it means the food always has to taste good, otherwise people don't buy it again. They buy it once and never again. But the food has to provide nutrition and also be ethically responsible, no social issues in the value chain all the way back to the farms. So human rights, child labor, etc., non-acceptable. The food has to be environmentally sound and responsible. So you don't want, and there are many things in there: climate, regenerative agriculture, food waste, food safety, etc., right? And the food then has to be also personalized more and more, right? We have a consumer that now is used to buy food, buying nutrition now, and increasingly buying health and life, right? So with these trends, and without talking about the digital impact and the acceleration that COVID has had on digitalization and personalization, right? And the change in channels. So the context is the food industry, and the food industry is a little bit broken, if not to say very broken, in the sense that we are responsible as an industry for 25% or 30% of emissions, depending which study you read globally. Every day, 30% of the food that is produced is never consumed, is wasted. There are 2 billion people who are overweight or obese out there, and 700 million that don't have enough food, right? So, and we're using probably 2 planets to do that collectively. So there is a need for transformation there, and companies that are leading and have committed to lead, like Kerry, take a leading role. So ESG is the consequence of that. But what you do before that is basically look at the materiality of the issues and the impact you can have in the value chain. So for us, it was, we reach 1 billion people, roughly, through our customers, not direct, but we provide solutions that are turned into food that people buy. And we've looked at where we sell, and we know exactly how many people we reach, because we looked at our portfolio, we looked at who we reach, and we reach 1 billion people with positive and balanced nutrition, right? And our goal is to reach 2 billion people by 2030 with sustainable nutrition. And this is a public goal, and we've committed to that, right? So that's the foundation of ESG, knowing where you are, what your impact is in the value chain, and what your ambition is to fix. And when I say fix, is really transform the food industry. Plant protein is really a key not the only one, but one of the key enablers to do that, because it contributes to sustainable nutrition, which is more nutrition. So it means less cardiovascular, less fat, less salt, less sugar, hopefully, and less cardiovascular, less obesity, less a number of health benefits versus animal protein. And you do that with a significantly lower environmental footprint, right? So sustainable nutrition is bringing these two sciences together, more nutritional impact with less environment and less social impact. That's a big intro. Sorry for that. I come to ESG, right? So once you do that, it's very easy to develop a strategy where you say, okay, how do I turn my portfolio? How do I improve my product line and my solutions to maximize sustainable nutrition and minimize the risks, right? So once you do that, plant protein has to be very much part of the equation. 97% of protein is still animal nowadays in meat. In dairy, it's probably 85% is still animal-based. Plant protein is growing extremely fast, but it's still very small. But the companies who are at the forefront know that the future is around plant protein and alternative proteins, I would say, not plant only. So plants and precision fermentation and cell-based and anything else we can invent, right? Maybe I'll stop here to give Jed, I can see he's saying yes to add to this, and I can always come back. But for us, ESG is the consequence of doing all the things I've been talking about right, and then being able to explain that in the right way to the investors so that they know the investment is being de-risked. And not only de-risked, but we create risk and we transform that into opportunity, right? Which is market share, consumer, etc. So we do good and we do well at the same time. And it's not an or conversation, it's an and conversation.
No, I think that's great, and I'll be quick on this one. But I think the ESG narrative around alternative protein is very easy, very simple in my mind. The environmental impacts are massive, and the health and wellness benefits are clear as well. And so I think it should be a part of all impact funds or all ESG funds, investable universe, and I think a core focus for people. In terms of a little bit on where we sit at Barclays, I think as a financial institution, we have kind of an interesting spot as sort of in the middle of this. We have a very big sustainability efforts are going on internally. We've committed to be net zero emissions as part of our business, which is something we care about. And then we also have some other programs that are more specifically focused on alternative protein. We actually have made an investment in a company named Air Protein that I think is participating in the conference, and others may know. We put together a corporate venture fund to focus on investments in businesses that are impacting climate change and helping sort of mitigate or prevent climate change. So we're excited about that initiative, and we identified alternative protein as a sector and a category that fits well with climate change oriented strategy. And then secondly, we actually, another program we have at Barclays is an accelerator that we partner with a group actually out of Colorado. So Lisa, your neck of the world, called the Unreasonable Institute, that we develop Unreasonable Impact, which is another thing we're very proud and excited about. Which focuses on earlier stage companies, again, in the green economy, of which alternative protein has been a focus as well. And so we think this is an important sector and should be definitely part of sort of broader ESG and CSR initiatives.
Thank you. That's incredibly helpful. And the audience will notice that GFI has brought together three really fascinating viewpoints. We have nonprofits, we have corporate, we have institution points of view. So it's really interesting to listen to the three of you and how you look at ESG and how you're looking at risk reward, as well as the impact on the environment and people and nutrition as well. So we talked about the why alternative proteins as ESG, why is that important for investors? I would like to understand more on the how, and how does that affect where you sit? So how do you affect and apply these ESG strategies and these principles, and how does your organization apply those in your initiatives? So let's go back. So Jed, Juan, and Maria, can we go that way?
Of course, and sorry, I had a momentary Wi-Fi lapse, but do you mind just summarizing that real quick again, Lisa? The question.
Sure. We talked about the why ESG, why is that important? And I would love to know, how is your organization currently applying those principles, those ESG principles, and those sustainability initiatives? So if
Sure.
we can go back, like we start with you, Jed, and then we go Juan and Maria.
Of course, yep. And so my comments will be a little less specific to alternative protein, but that's obviously one category that is a part of our broader climate initiatives. And so we've done a couple things. One is I mentioned we came out with a public goal of being net zero emissions. For us, it's by 2050. And the way we think about that, it's across essentially all the companies we do business with. And so if you think about it as a bank, we lend to almost every company, or at least every sector. And so we have, pretty significant emission footprint through the businesses we're lending to. And so our goal is looking at a lot of our lending portfolio as well as our financing portfolio, and how do we become net zero as a bank. And so for that, we've actually been working with BlackRock and some of the data analytic capabilities they have to really help measure our loan portfolio, our carbon footprint, and really come up with a reduction strategy, really focus a lot on some of the heavy emitting sectors and reducing some of our commitments there, as well as then also trying to offset that by really supporting the companies that are carbon negative to some degree, right? The businesses that are more sustainable and leading the transition across different sectors. So we're de-emphasizing a little bit the heavy emitting sectors, and then trying to put resources towards the more positive impact oriented companies. So that's at a macro level. The other thing we've done is we have kind of a green financing goal. And so we're trying to either help companies issue green bonds, green loans, other kind of green oriented products, and raise capital tied towards specifically green initiatives. And we have a broad goal of raising a certain amount of capital for those efforts over a 5 or 10 year horizon. So for us, it's a very kind of top down approach of setting these goals and then coming up with teams and efforts internally to make sure we're achieving them.
Good, thanks, Jed. Well, maybe I'll take the GSE in that order to tell what we're doing, right? So on the governance and strategy, well, the first thing we did after we did the materiality analysis maybe 2 years back, then we said, okay, we need to accelerate here. We repurposed the company, right? And our company purpose is inspire food, nourish life. So you can recognize inspire food, it's about innovation, and nourish life, it's sustainability. And that's our strategy, innovation to create impact. And we know our vision is to become our customers' most valued partner to co-create. So we create a world of sustainable nutrition. So that's the vision. So it's in everybody's job in the company, right? It's not something separate. We're here about to create a world of sustainable nutrition. And the goal is 2 billion people that we reach with sustainable nutrition by 2030, right? Now, what we've done is underlying that there are 5 themes, which are the strategic themes: nutrition and health, climate change, responsible sourcing based on regen agriculture practices. The next one is circular economy, food waste minimization and plastic. And last one is social impact in all the value chains where we operate. And we have metrics, we have goals and metrics for each of those, right? For climate, science-based targets, 50% food waste reduction, 100% responsible sourcing, et cetera, between now and 25 and 2030. Encourage people to go to our website and see the details. I don't want to, give you all the specifics now. It would be maybe not so interesting. But we've embedded that then into the governance by we have a board committee, sustainability. We have a global executive council, and we cascade that all the way down at the working level, all through the organization, right? So it's embedded in the way we manage it. So you've heard about the strategy. It's also embedded in the way we execute, and it's also embedded in the rewards and performance management, right? To give you an example, our execs, their long-term incentive pay is at risk for 20% for 3 key targets, which is climate, food waste, and the reach for sustainable nutrition, right? So that's the governance, and there are many more details there. But if I go to social, right? So we've measured the impact of our portfolio, 18,000 SKUs for sugar, salt, and fat, to give you an example, right? So we know how much of our portfolio contributes to a green, a yellow, or a red label according to the UK traffic light when used in standard formulations of food, right? So 80% of our portfolio used in standard formulations is either green or yellow under the UK traffic light, right? Which we looked at is the most stringent nutritional profiling out there. You can't compensate like others. You basically, if you're red in one of the categories, which is sugar, salt, fat, trans fat, saturated fat, you're red, right? So basically, by doing that and by looking at the full portfolio, we could then calculate the impact we have currently on 1 billion people, right? Which is our social dimension on how we contribute to nutrition, right? So that's one example. So everything we do, and that's the principles of ESG, needs to be measurable, proven on data, transparent, and we've published the methodology. It's been done with external nutritionists, parties, etc. So I think the principle of measuring and disclosing is very, very important. And then the last but not least is on the environmental side, right? So we've obviously calculated the baselining at corporate level, at site level, but we're doing that at product level now, all the way back to the farm. So you can use second-party LCAs. We're doing first-party LCAs, okay, as well, calculating the carbon for our key products and technologies all the way back. And so if you go to plant protein, right, so we have looked at our specific proteins because not all plant proteins are born equal, right? Almonds, lots of water, rice, lots of CO2, soy, lots of deforestation sometimes, etc. So the footprint is different across the portfolio. So we're really looking to optimize within the protein from animal to plant-based, and within plant-based to go to the lowest and best quality proteins that have the lowest environmental footprint, right? So this is a work we're doing as we deliver on our portfolio. So it's all operational if you want, but it's all of what the investors want to see when we disclose what we're doing, right? And some of this is work in progress. We only disclose when we're 100% sure that our data is in order and that we can stand by what we're doing. But as you can see, it's an iceberg of many, many things going on to be able to do that, right? And I can say that last but not least, maybe a little bit of advertising. We had the World Benchmarking Alliance yesterday published their first benchmark ever on food and agriculture on the top 350 food companies out there, and we were in the top 5%, right? So, but to get there, it's a lot of hard work, right? To be able to get this recognition. So sorry for the ad, but my team is super proud, and they said I should mention that.
I mean,
and FAIRR is coming. FAIRR is coming on 29th of September, and I'm really curious to see how we did on that one. But Maria won't tell me.
We're not going to give anything away. No, but I mean, a lot of what Juan said is absolutely right, and partially the reason why FAIRR exists. So I mean, we bring ESG in, and it's absolutely foundational to FAIRR. We, the genesis of FAIRR actually is embedded in ESG, looking at originally the food system and particularly intensive animal agriculture through an ESG lens. And the team produced one of the first reports on factory farming assessing investment risk back in 2015. This is when, again, a number of these ideas or ESG risks weren't really attributed to the food system or to intensive animal agriculture. So we do a bit like what Jed described. I mean, making the case from the top down. So, how does intensive animal agriculture to contribute to negative externalities, whether it be the overuse of antibiotics, waste management, water use, deforestation, biodiversity loss, how this industry deals with its workforce, and and again, looking at the opportunities afforded by plant-based or alternative proteins, as you rightly said. And so we produce research and practical tools through an ESG lens, specifically for investors. So looking at this intersection of financial materiality and really honing in on the issues or the data, the indicators that we feel are most relevant for investors and companies to be reporting and using, bringing into their investment process. And the way that we go about doing that, besides your typical sort of thematic reports or reports on whether it be reports on deforestation or aquaculture or a particular protein, et cetera, is we try to bring that to life with sort of practical tools. So FAIRR has produced a couple of different tools for investors. Some of this is publicly available, so you can feel free to have a look on our website. But really, one of the world's first benchmark looking at the animal protein sector. So we benchmarked the 60 largest listed meat, fish, and dairy producers globally against the most financially material indicators, some of which, that Juan directly referenced, and that pertain to some of the ones that I previously mentioned as well. And again, this gives investors and companies a really good indication of what the end goal should be, what best practice looks like, and where they are in sort of this journey to get there. And we rank those and update that on an annual basis. And we also produced the first climate risk tool that looks at physical and transition risks for the meat sector. Again, with the idea that, we are trying to address a challenge that investors have in thinking about this sector and how to value the sector, how to look at value at risk. And then we also sort of look at the other side of the coin. So how does dialogue with companies improve outcomes on certain issues? And, working with companies like Kerry and Juan are, a great case study example where we, have a theme or issue that investors are concerned about or want more information about, in some cases quite novel, whether it be antimicrobial resistance and the overuse of antibiotics in the livestock supply chain, or the diversification of protein supply chains. So thinking around how companies may want to value, address, and measure their shift away from the over-reliance on animal proteins in their product portfolios. So these are quite novel topics. And 5 years ago when we started, much of the capital markets community looked at us with a bit of puzzlement, because they thought, what is this issue of diversifying protein supply chains? And through this process of thinking through an ESG lens, again, coming up with data that needs to be reported, the need for corporate transparency, this measurement, and having your eye on at least some best practice goalposts so that we can help, in partnership with companies, move the entire industry in a direction that hopefully will create a more sustainable food system. So again, trying to bring together a lot of sort of JED's expertise from working with corporates, investment banking, and working very closely with leading corporates like Kerry to bring these issues to the fore for investors.
Thank you. Okay, Jed, actually, the next question is for you. What are you hearing from institutional investors on these topics? Has that changed over time, or has it pretty much remained the same?
Yeah, no, it's a great question. I think it's really just building off a lot of what Maria was saying in her comments. I think what's interesting from our perspective is, we are a traditional financial player, and I think we publish and focus on things that are a response to what investors care about. And so I think one thing that's interesting is looking at our research division. They published a big report a couple of years ago on sort of the market potential around plant-based and alternative protein. They've been excited about Beyond Meat and Oatly's IPOs and stock price performance, and it's been a kind of core topic of our consumer conference that focuses on large CPG companies. And so I think what's interesting in my mind is, I think financial investors, they obviously, a lot of them do personally care about the environment and health and wellness and these themes, But I think at the moment they're seeing these as kind of investable trends, right? To your point, Maria was saying around supply chain issues. This is not necessarily, this is no longer a sort of nice to have. This is a core material financial risk that these solutions are solving. And so I think the resiliency point is important. I think just the sort of the consumer preference and the consumer excitement around some of the products is real. And you see if you are an investor in the consumer space, there's not that many high growth companies. And so it happens to be a lot of the most exciting and highest growth businesses at the moment are in the plant-based and alternative protein sector. And so I think it's gone from sort of more of a sort of just pure ESG lens into a kind of more traditional or mainstream financial community where they're seeing these are the opportunities where we can make really good investments. And I think that narrative is part of why they are good investments, but they're both deeply linked together as part of a package.
Got it. Maria, what about you? What about from your time working for investment firms like JP Morgan, Deutsche Bank, to your time managing signatories for the U.S. supported Principles for Responsible Investment, PRI program, to your work that you're doing in FAIRR today? How have you seen investor interest in and the use of ESG principles evolve? Given this, do you think that it's important for an organization like FAIRR to exist?
Loaded question, Lisa.
A little softball for you.
Well, look, I guess I'm kind of a dinosaur in the ESG space now. I mean, I was working in investment banks, a good 20 years ago, and I had the experience of working in emerging markets, right? And in particular, Latin America. And investors then had to think about some of these potential ESG effects when they were investing in those markets, whether it was El Nino and anchovies or drought in Brazilian electric utilities or, worker safety or privatization of mining companies. But I think we've really seen an evolution, again, to Jed's point, it really has been embedded much more and now has extended to developed markets where perhaps more stringent regulation had given us the impression that some of these ESG issues were perhaps less risky, right? And we know now that's absolutely not the case. So we've made so much progress in terms of awareness and understanding of the value at risk and of externalities. And really now it's about thinking hard about how these risks will play out. And importantly, we now are actively valuing companies, which again, as Jed mentioned, are getting ahead of the market, both on the de-risking side, as well as looking for innovative new strategies and avenues of opportunity. So, I mean, it is extremely important for organizations like FAIRR to exist. One is, we'd like to think of ourselves as an independent, not-for-profit voice in this space. And I think we've, done at least to date a pretty good job of filling a gap on these issues and shedding light on a particular industry or supply chain. And prior to us existing again in 2015, obviously there's a number of other great organizations that are looking at this now. There was little research on food systems and protein through an ESG lens. And so I think not only do we bring to the market this more understanding about the direct risks about intensive animal agriculture and the supply chain risks, but also this idea of the strategic opportunities that can really differentiate potential portfolio companies for an investor. And I think that's where we have seen and where we're continued to see alternative protein playing a really big role. And obviously FAIRR has been engaged in there for the past 5 years and welcome, all the players in this space now to make sure we sort of fast track this transformation.
Great. Okay, Juan, what about you? What about Kerry's group's investors? What are you hearing from them, as well as those that are your clients, about sustainability strategies, and have alternative proteins enabled you to meet those investor and client preferences?
Let me start from the consumer maybe, and how we look at what we share with the investors. We just published recently Sustainability in Motion research, right? That shows that half of the consumers are looking for products that have a sustainability benefit, right? And among that, plant protein and alternative protein is one of the key themes. Not the only one. Food waste is growing in importance. And you have health and immunity is another type of growth in importance. But that research was very very foundational, because we saw that consumers is not anymore consumers want sustainability but they don't buy it. We're talking about moving to buying and actively buying, right? And so it's US, it's Europe, and it's Asia as well, and it's a very large proportion. So we had seen that also in our business, and for us, alternative protein is one of the 4 key growth pillars that we have, right? We have I won't give you the full story. We have a Capital Market Day coming October 13, right? But let me tell you that it's definitely making the top 3 or 4 priorities for our company, and it's definitely a source of both market value and shareholder value, right, for Kerry. We've taken a very integrated approach through that. We've put a portfolio of solutions through that, because it's not only selling the protein, you have to optimize the taste, you have to optimize the nutritional aspect. Unfortunately, some plant-based food still are too heavy on salt or fat or sugar. So we really are we're becoming the specialists on how to, clean the recipes, make sure you don't have long lists of unwanted things, that you really stay as close as possible to the benefits of fresh plant-based when it goes into processed, and that you are really delivering taste, nutrition, short lists of ingredients that the consumer want, and minimizing the environmental footprint, right? As we're doing that, we're seeing very significant growth in the market, but we're seeing above and beyond significant growth in the plant-based or alternative plant-based protein of people that want to start to to differentiate, right, around the high nutritional value of the food, right? So we're starting already now to see the market segment. And that's good news for us because it plays to our strengths, right? And so in that sense, we are accelerating our investment here because it's a very strong growth opportunity. It's also a fantastic ESG opportunity from an impact point of view. So it's really a win-win-win for people, for planet, for customers, for Kerry, and for shareholders.
Jen, what about you? What about your organization? How is it helping investors and corporate achieve those ESG related goals through alternative proteins?
Yeah, I think a lot of what we're trying to do is sort of bring people together and intermediate sort of both sides. I think there's a lot of interest from the corporate side in achieving big sustainability goals. So there was one question around, are other banks doing what Barclays is doing? And there are. I think I would argue European banks are probably leading a little bit, but across the sector, there's a big focus on sustainability and setting some of these goals. The question I think is then, how do you enact that, right? And so I think understanding, what companies can you invest in that has an impact? What new business lines can you create that helps your company transition? I think our goal is really around trying to, once people are usually deciding to do these sustainability goals on their own, right? Their investors, their board members, their employees, people are pushing them from a variety of different perspectives to come up with these goals. I think the next step then is, how do you actually implement them and achieve them? And that's where I think there's a lot of work being done on, looking inward at your own supply chain and your own impact, and starting to actually measure that. And then thinking about, what can I invest in? What can I acquire? What can I sell to sort of help me achieve those goals? And I think that's where we as kind of investment bankers can help play.
Got it. Okay. I think that is all the time we have for the panel's discussion questions, but we are transitioning into Q&A. So if you have a question, please feel free to add it to the chat. While we do that, I'm going to ask one more question. Juan, I wanted to really ask you this question. I want to make sure that I cover it. But for anybody else who's listening to the panelists and you want to get your question out, just feel free to put it in the chat. All right, Juan, so given your leadership on Kerry's sustainability strategy and the fact that you have oversight over venture investments, partnerships, collaborations, how do you think about the role of internal product development versus investments and partnerships in startups and in growing Kerry's participation in alternative proteins? How do you divide that? You're on mute, Juan.
Yeah, so this is a great question, and this is something that, as part of the strategies, you're always looking. What do you build? What do you buy? And where do you partner? Right. And so I think the whole we have bought. We had solutions already in the plant protein space and the alternative protein. We have bought a number of companies recently or partnered there, Pevesa, Oya, and a number of others. We also are partnering, and I think the partnering here is very, very important. So open innovation in that context is critical, right? Because nobody has the full solution. As we're exploring new areas to develop proteins, and we touched on that a little bit at the beginning, right? The space around fermentation, and particularly precision fermentation. How do you use new substrates to create protein, waste to protein, for instance, and being able to repurpose. So bringing circular economy and the protein agenda together and the food waste minimization together. So that's a big theme. And as you look then to the cell meat, and not only cell meat, cell seafood, cell eggs, cell whatever. So there are waves of protein solutions that will come out there that need to happen, right? If you go to the very beginning, if everybody eats protein using the same diet than an American consumer, we would need close to 5 planets if all the Chinese, Indians, and Africans start eating on the same mix. It doesn't work, right? So that's why the mathematics don't jive. So we're going to have to be able to find new technologies and new innovation to break through and fast track what we're doing. We're just at the very beginning of what needs to happen. And I want to make clear to everybody, this is a steep curve, and it will require deep investments, and not one company can do it alone. So it's going to, we're going to have to figure out ways to de-risk this and invest faster to get to the outcome where we can have 7 billion people that do not have a diet which is rich in carbohydrates, but that is rich in proteins, so that they can have, and I go back to what I said at the beginning, it's not about food, it's about nutrition, health, and life. So if you only eat carbohydrates, you can't have that. You need proteins to be able to have the level of life that we all expect for our children, right? So I know it's a very high-level answer, but I think the way we do that then is the usual suspects of, participating in accelerators and looking at funds and looking at other types of open innovations with institutions. So that's the usual mix. I wouldn't say Kerry has been, we've been more doing traditional M&A, but we're looking more and more at investing in open innovation in an earlier stage. But I wouldn't pretend that we're the biggest or faster in this space yet.
Got it. Okay. So at the end of the day, it becomes about partnerships and all a big collaboration from different entities. All right. I want to answer this question from Kimberly. And Maria, I see that you answered a little bit, so I'll throw it to you, but let me read it first. Love that the importance of transparency has come up. How can those in the all protein industry improve transparency? And what is your recommendation regarding how companies can meet investor and stakeholder expectations in this regard? Maria, do you want to kick us off there?
Yeah, I mean, I guess, it's one of the big questions, and, investors increasingly want to know more about how alternative protein companies are, creating their products and sort of what the environmental and social impacts can be. And I think transparency is really important. We're going to have to work with this industry in understanding what the material data points are, I think, and we can do that in partnership. So I guess there's probably some initial reticence about sort of putting yourself out there and saying, hey, these are the data points we're tracking. Are we, disclosing this in a way that you find most useful? But I think that's the way, at least we found with some of our more novel dialogues with companies, that if there's if there's trust built around the dialogue, so that we can work through some of the challenges of, what data points are most material, most valuable, how can we report this to the broader market. We can build out sort of a transition and data disclosure in a way that is fast tracked, instead of going back and forth and trying to be sort of hit and miss on whether or not we are looking at some of the key critical issues in the most valuable way. So I would suggest being sort of open and honest about some of your challenges about disclosure, and working with those organizations that you feel comfortable and you feel like you've established a relationship of trust, so that you can start disclosing the information that investors and stakeholders want to see. And many times, we don't exactly know what we want to see. We know what we think it looks like, but it's, it'll be trial and error until we get to exactly what is sort of a most meaningful data point that the market can use, and you and your peers feel comfortable in disclosing.
Yep, that makes sense to me. Jed, do you want to take on Monica's question about venture debt to startups as part of the Unreasonable Impact Partnership?
Sure, yeah, and I'll cover that one quickly, because there's a bunch of interesting questions here coming in the list. But so on that point specifically, so the Unreasonable Impact Program is run by our citizenship initiative, and so it comes with sort of no strings attached. So there's no equity investment or no sort of financing support through that program specifically. The way it works is essentially, people leverage their experience and their networks to try to help people grow their companies. We do have venture debt, though, as a service. So there is a group that provides venture debt. We have project finance, a variety of different efforts. They're just not specifically tied to our Unreasonable Impact Program.
Thanks, Jed. All right, Marley, we'll go with your question next. And it says, I've seen ethical debates about whether it's fair that fossil fuel companies who knowingly contributed so greatly to climate change get to reap profits if they transition to sustainable energy. Do you see consumers with the same ethical concern applied to conventional meat companies in their shift to plant-based? And do you think this gives plant-based startups, who are arguably being eco-friendly from the start, an edge in the conscious consumer mind? And I'll open up to any of the panelists who wants to answer that.
Yeah, it's an interesting philosophical debate. I would answer the following way: it's interesting to see what consumers are buying and what categories are growing, and which companies are growing faster. And without going into specific names, I think that there are winners out there in the plant protein space, and there are companies who've tried at following them, maybe big names, and haven't been as successful. So I think I would say it's a very general statement, so I want to be careful here. Let's say that in general, the newcomers seem to be growing faster than the incumbents. I'll leave it at that. And they are all customers to us, so you'll understand my sensitivity here.
Look,
okay.
Maybe I have a different view. I think at this point, given Juan, or maybe I share you, but the percentage of the market that you think that you've noted that plant-based protein makes up an alternative protein is so small. I think
you're right.
I don't see that. I see where you're coming from in that it's fossil fuel companies, but in many cases, a lot of these companies bring expertise that can help transition them, right? I mean, we've seen it happen in the auto sector. We've seen it happen in the electricity sector. All of these industries have had to transition and look at, renewables or more sustainable avenues. And, if they can bring their experience and help fast track a transition of all these sectors in the right way, I say, bring it on.
Yeah.
And there, I think at this point, there's room for everyone. And there will be those who come with more innovative ideas that have less bureaucracy, that'll be more nimble. But again, we'll need financing to get those innovative smaller companies to a scalable point.
Yeah, Maria, I don't want to give the impression that it's either or, it's and, right? I was looking at, I answered from a consumer point of view but there are exceptions to that, right? When we launched, Kerry Foods launched Richmond vegan sausage, the Richmond vegan sausage became number one very, very quickly in the market, right? So even very traditional brands in the UK, a sausage, you can't imagine more traditional than that. We said, okay, let's try to, under the same brand. So we did both launching it under the same brand, Richmond, and we launched Taste Glory separately. Different categories of consumers here, different demographics, positioned totally differently. In the end, both plant protein solutions. So I think it comes here. We're not talking ESG anymore. We're talking marketing, segmentation, different consumer groups that want to buy different things. And you're addressing: are you selling to the vegans, the vegetarians, or the flexitarians? And the growth is coming from the flexitarians, actually, which is 60% of the population that is open to diminish their meat protein intake and put up their alternative protein intake. And that's where the big growth is coming from, because it's not a niche market anymore, it's mainstream. So my answer was from a consumer point of view.
Yeah.
Then who wins? Right. Who wins at the company level? That's where it gets very interesting, because it really becomes a question of competitiveness of small, nimble, and innovative versus large and at scale. And both have a right to win, but it depends how they will play their cards in the next 5 and 10 years, right? And it's there is no clear winner out there, I would say, at this stage. It's all open, actually.
Yeah, agree. All right, I am going to go with Pete's question, and then if there's any last questions, we have about 3 minutes before we close up and say goodbye to our amazing panelists. So the question is, which geographies or markets do you see public companies in this space, as most of the innovation tends to happen in private markets? And open to any of the panelists who want to give your perspective on this.
I can take a shot at sort of for some initial thoughts. It seems to be a kind of a combination of, is it more private or public companies, and then which geographies, I think is sort of the question. And my answer may be the more straightforward one, but I do see a lot of innovation in private companies, and I do see a lot in the US, from some of the traditional hotbeds like California, but other areas across the country as well. I think that's probably the simple answer to it. And Juan, I'm going to give you the opportunity to counter me, because I know there's a lot of innovation going on at larger companies as well, and I do think it's coming from both sides. But I do, without a doubt, maybe one way to frame it is, there has been an incredible amount of investor interest in startups in this space, and we're seeing a lot of really interesting early stage companies being supported by both dedicated venture funds, traditional venture funds, and a variety of investors really looking to help build.
You're right. I mean, we're partnering a lot with innovators, and we are becoming, for them, we help them scale up into their formulation, etc. You might have an ingredient, but that doesn't mean you have a solution, right? So what you need to do is formulate it into real food that tastes good, is nutritionally optimized, etc. So the AND equation, putting it together, if you have some pieces of the Lego as a startup, that doesn't mean you have the flying machine you can put in the big box, right? So the big corps bring first the capability to put all these pieces together. When I was a kid, I was very bad at building the flying machine, because Lego had not come back up yet with the big boxes. They were selling it in pieces, right? So startups, to a large extent, that's what they have right now, the pieces, etc. What the big companies have is the capability to put it into toys and flying machines. And then the other thing we have the capability is knowing what the kid wants. Does he want the rocket, the helicopter, or the jumbo jet? Because different consumers want different flying machines. So the capability to package the right pieces in the box with the right instruction set, excite the kid and get it done, that's where the scale and the big companies bring to the small startups. Now, the small startups very often have a fantastic idea, but being able to scale it up, that's where the two sides collaborate. And I won't give you a long list, but we have a long list of startups which are not startups anymore, which are in 2 or 3 years very large companies, and we've helped them to get there, right? And so that's the role of corporates, not only in the investments. I think cash is important, don't get me wrong, right? But I think the intangible of industrial scalability, formulation, consumer testing. All of these intangibles is what big corporates can bring, and that's the value on that is phenomenal for the startups.
Yeah, it goes back to the previous question, right, Juan,
Exactly.
about whether sort of existing companies can shift. I think it brings everything that you just mentioned, right?
And we do that with a lot. We do that with a lot of small and medium-sized companies in the market there, not only the big ones, right? And that's the innovation very often happens at the intersect, at the wide space of things, right? And so being able to do the end is probably where the most of the innovation happens, right?
That's the perfect ending to our panel. Thank you, Juan, Maria, and Jed. You've been amazing and so interesting. And thank you I wrote so many, literally 2 pages worth of notes from the things that you said. So thank you for your contributions, and we appreciate you and your presence so much on the panel. At this time, I'm going to ask you to turn off your camera so we can introduce our 2 next presenters. And thank you for everybody who attended this piece. And of course, if you have any questions, just reach out to the panelists.
Thank you. Bye.
Okay.
All right. Hello. All right. So it is my pleasure to introduce our first presenter, Joe Raven, which is the Senior Manager, Research and Engagements in the FAIRR initiatives. And Joe, very apropos to our conversation that we just had, is going to speak about how Big Food is measuring progress in the protein diversification space. So Joe, I will give it to you to introduce yourself and get us started on the
presentation. Thanks, Lisa. Hopefully everyone can hear me and see me. I can see the slides, so thanks, Molly. So hi, everyone. Thanks for tuning in. I'm delighted to be part of the conference today. So my name's Joe Raven, and alongside my colleague, Maria Lettini, who you may have heard on the panel earlier on, I work for an organization called the FAIRR Initiative. As some of you may know, it's the fastest growing ESG network with over 40 trillion in assets. So just perhaps going on to the next slide. And we really focus on raising awareness of these material ESG risks and opportunities caused by intensive animal production. And we work with investors. I mean, many, I'm sure you recognize on this slide, to prioritize these different issues through research that can be integrated into their investment decision-making, their active stewardship processes. But we also run collaborative engagements with companies on behalf of our investor members. So with a number of different global food companies focused on improving company performance on selected ESG issues. I head up our engagements with global food companies across a number of issues, including specifically on protein diversification, which I'm going to spend a few minutes talking around that, and of course the issue of metrics. So moving on to the next slide, please. Actually, can we jump onto the next one? Great. So the pandemic has been a massive stress test for the animal protein industry, and it's exposed the vulnerabilities of today's intensive centralized production system. It has brought urgent focus on the need for greater resilience in the face of growing sustainability challenges in what is an increasingly resource-constrained world. It's also been a catalyst, though, for accelerating innovation in food tech and driving government-level action with that focus on healthier, more sustainable diets and ultimately long-term food security. And shifting from a reliance upon animal-derived proteins towards these diversified portfolios, including plant and alternative proteins, is essential, both to meet shifting consumer and regulatory requirements, but also to achieve ambitious climate targets. And I think over the past 5 years, FAIRR has undertaken extensive engagement with large publicly listed companies and institutional investors on this topic, really helping to catalyze this shift. And what has that meant, really? It's really about asking these companies to evaluate their current exposure to animal proteins and the risk profile of these supply chains, and then assessing the strategic implications of growth plans that are based on a higher reliance on animal proteins through, for example, scenario analysis. And these steps provide the evidence base for the material risk of high undiversified exposure and ultimately inform the development of commitments at that highest level to transition business models towards these less resource intensive ingredients and products. And from a more practical perspective, it means having cross-functional strategies that involve R&D, marketing, sustainable sourcing, and many other teams within a business. So on to the next slide. And investor support, so institutional investor support has grown by more than 1,300% since it launched back in 2016. And it really is just an indication around this increased recognition of the link between intensive protein production, climate change, and diets. Next slide, please. And our focus is on the largest global food companies with significant market share at the regional and global levels. And these companies have complex animal protein supply chains, often spanning multiple markets. And I'm sure many of you recognize the names on these slides. And these are all companies that have a huge role to play in creating a sustainable and equitable food system. Next slide. And this year, what we have actually been asking companies is to encourage them to build on previous high-level ambitions by specifically setting time-bound commitments to support a clear pathway for action, including the development of relevant metrics to measure and ultimately publicly report on progress. Next slide. And clear time-bound commitments are absolutely crucial to measure progress and ensure accountability. And after 5 years of engaging with these large publicly listed food retailers and manufacturers, FAIRR and investor signatories have achieved quite a big milestone, actually. And we have 7 companies that have set targets to increase volume and sales of meat and dairy alternatives and or reduce brand level emissions. Some of these I've listed on this slide. I won't go through these in detail, but it's important to note that while these targets are not perfect, they do demonstrate a significant evolution in recognizing the materiality of this issue as a crucial aspect of both growth, but also carbon mitigation. Next slide. And of course, a key aspect of any target setting is the development of internal capabilities and systems to track relevant and meaningful metrics that showcase progress. And this has been a real challenge over the last few years, given questions around the lack of standardized definition of, what does plant-based mean for these companies, and also IT infrastructure challenges, amongst other things. But progress is being made, and we're starting to see a variety of metrics that are being developed and publicly reported on. I'm actually giving you all a snippet of our upcoming report on this topic, which is out next Wednesday. But as you can see on the slide, there is considerable variation when it comes to metrics, at least at this stage. Companies are tracking volume of sales, revenues, growth rate, product carbon intensity, and plant-based proportion of assortment. So for example, Tesco and Sainsbury's, UK retailers, are focused on volume of sales. Unilever is tracking proportion of plant-based products in specific portfolios such as ice creams. Kroger is measuring total revenues generated by plant-based products in certain brands and categories. And in our view, the best metrics should provide a clear picture of how the entire product portfolio is shifting. So by tracking changes to protein composition across relevant categories and or brands, and this includes, of course, fresh and frozen meat, seafood, ready meals, dairy, and eggs as ingredients as well. And metrics should ideally reflect the evolution in revenue exposure to animal-based versus plant-based and other alternative protein foods. But ultimately, transparency on the underlying criteria and methodology being used is absolutely essential. Next slide. And so far, I've spoken from a top-down perspective when it comes to the development of the alternative protein ecosystem. And as this sector continues to develop and more pure play alternative protein companies IPO, there is increasing scrutiny on how sustainable the industry, companies, and brands in this space actually are. And the diversity of technologies makes it hard to develop a standardized framework. But earlier this year, FAIRR published an initial framework highlighting the relevant material ESG risks for alternative protein companies and brands. And these are very much dependent on technology type and growth stage in the ecosystem. I've included a snapshot on this slide, but it might be too small for some of you to see. You can download this from our website, but issues like monocultural farming, for example, are of higher relevance to a plant-based company than it is for a cultivated meat company. And on that note, I'm really absolutely delighted to share with you all today, next slide, that we're now building on this initial framework through a collaboration with GFI. And the aim is to build an ESG impact measurement framework for the industry and for brands, which can be used by investors to support due diligence and the integration of ESG into the assessment of this industry. The framework will also provide a roadmap for established food companies as well as early stage companies to guide their reporting and communication when it comes to their impact value proposition to stakeholders. And as part of this process, we will be looking for feedback on metrics as well as on the broader framework. So if you would like to be part of the process, please do reach out to GFI and ourselves as well. And in terms of timeline, I mean, this is something we're hoping to publish sometime potentially in the first half of next year. So on that note, that's it on my end. Hopefully you found the session useful, and if you have any questions, feedback, ideas, as always, happy to chat. So just feel free to reach out. So thanks everyone, and I'll pass over back to you, Lisa.
Thank you, Joe. All right, our next presenter is Devon Bonney, which her title, pretty long but amazing, is the Analyst of the SASB Standards Food and Beverage Sector Lead in the Value Reporting Foundation. And Devon is going to be covering the SASB Standards research, metrics, and results in alternative proteins. So Devon, I leave it up to you, and I will mute myself.
Great, thanks, Lisa, and it's a pleasure to be with everyone today. So as Lisa mentioned, I'll talk a little bit about what type of research we've been doing at the Value Reporting Foundation in relation to alternative products and how that fits into the SASB standards. So next slide, please. So I'm just going to give a brief overview of the SASB standards so we can level set with the audience and you all understand sort of what the organization does and what the standards are meant to achieve. I'll go into a little bit about the research that we have found over the past year and a half or so, what the implications are for the standards, and then next steps and how members of the audience today can be involved in the project. Next slide. Next slide. So just to start with the SASB standards, we have 77 industry-specific standards that are used by companies and investors all across the globe. Next slide. And really, the SASB standards were created because companies were reporting ESG information in CSR reports and not really highlighting exactly what investors needed. And so the SASB standards were really developed to bridge that market gap so investors could understand those ESG impacts that are likely to affect the value creation for companies over the short, medium, and long term, and allow companies to report in a way that would meet their investor needs. Next slide. And therefore, the SASB standards really highlight those ESG topics that are likely to impact a company's value creation over the short, medium, and long term. They're also meant to be decision useful for both investors and companies, and that includes having those industry-specific standards and metrics that can be comparable for companies within the same industry. They're also meant to be cost-effective for companies to report to, industry-specific, which I've talked about, evidence-based. We have a very robust process, which I'll talk about, and market-informed as well. Next slide. So the way the standards were developed is we started with a very broad, five broad dimensions of sustainability, being environment, leadership and governance, business model and innovation, human capital, and social capital. And then under these different dimensions, we have a variety of ESG issues. And this is sort of the universe that the SASB standards view as those ESG issues that are likely to impact a company. Next slide. And so we took those sustainability issues, we conducted industry-specific research, really understanding what the evidence of financial impacts were for each of those issues and for each industry. got market input from companies and investors, vetted that evidence with our standards board, released exposure drafts for public comment, and then we have now what is the 77 industry standards. And those standards have an average of 6 topics and 13 metrics. And right now we're undergoing an ongoing standards maintenance process, which I'll talk about in just a minute. Next slide. So just as a brief introduction to the food and beverage sector, there are 8 industries. And so our research on alternative products really looked at how is the growth of alternative products impacting almost every single industry within the food and beverage sector, with the exception of agricultural products and tobacco. Next slide. And so this is an overview of how we go about standard setting. Alternative products really started as a monitoring industries and issues, so that far left. And really this was because we saw the growth of consumer demand, and we saw that they could be related to some environmental impacts or help traditional companies reduce environmental impacts. And so we wanted to explore that a little bit more. And in May, our standards board initiated a standard setting project, and that will mean that we'll develop different metrics and potentially topics related to alternative products for some industry standards. We'll release that for public comment, and then eventually issue a standards update if appropriate. And so there's lots of ways to be involved in that, in this research, from initiation all the way through issuing a standards update. Next slide. Next slide. So, yep, can you click through this? Thanks. So really we were trying to understand, when we started this research back in February of 2020, what really were those consumer demands, and then like why are all these products increasing, and then what is the actual impact. What we found is that 65% of global consumers are eating more plant-based food and beverages for reasons of health, animal welfare, and environmental concerns, which we heard a little bit about in the panel earlier. And we also wanted to make sure that these products actually helped reduce environmental impacts. So when we looked at different sort of categories of alternative products, such as plant-based, fermented, or cell cultured, or lab-based, we found that they could help reduce land use impacts, GHG emissions, and water use pretty much across the board for both meat and, in this case, milk products, but dairy products in general, pretty substantially. And so once we understood there is this growing consumer demand, they help reduce environmental impacts, we wanted to dive into what are the financial impacts. Is this just a trend, or is this something that's likely to continue over the long term? So can we go to the next slide? And when we looked at the financial impacts, we found that this is really here to stay, as I'm sure most of you know in the panel. So on the left is a chart of the meat market by A.T. Kearney, and they predict that by 2040, plant-based and cultured will actually be the majority of the meat market, with traditional meat only making up 40%. And this is important because as consumers transition to more plant-based or cultured meat, it could jeopardize traditional meat companies, and they'll have to diversify in order to meet that consumer demand. And then we've also seen sales of dairy products decline over the past decade, but especially in 2018 to 2019, we've seen that while traditional milk, yogurt, and cheese sales have declined or stayed the same, alternative product sales have increased substantially. Next slide. And I'm sure we've all seen just headlines in general of a few different dairy companies had filed bankruptcy, both citing that the demand for non-dairy milk led to some of those issues, whereas Oatly just IPO'd and that valuation was 10 billion. We also see companies reporting their growth rates, as Joe mentioned, being in double digits compared to some of their other products. So this is just to say that it is truly financially impacting traditional food companies. And so next slide. So when we sort of combine the environmental impacts with the financial impacts, we see that there's strong level investor interest in understanding what more about these ESG impacts and what companies are doing for product diversification, as Joe mentioned. Companies have told us that they're using alternative products to help manage ESG impacts and meet consumer demand. And our research has indicated that too. And when we look at how it's sort of impacting different companies for meat, poultry, dairy producers, food retailers, and processed foods, we've seen it can really help reduce GHG emissions of their product portfolio and across their supply chain, as well as for meat companies, help them reduce water use, mitigate land use issues, and animal welfare concerns. And this is really the feedback that we needed from the market to say, okay, there could be a way to improve the decision usefulness of our standards by adding in metrics related to alternative products. So next slide. And so now we'll talk a little bit about how this research impacts our standards. So in order to initiate a project, we have to make sure it's mission aligned with our organization. So is there an opportunity to increase decision usefulness? And what we found for meat, poultry, dairy, food retailers, and processed foods is that there is an opportunity to increase that. As Joe mentioned, developing metrics, we think that there is an opportunity to create more comparable information or metrics related to alternative product strategy that will help investors make decisions and help companies understand where their risks are related to protein supply chains. This is a globally pervasive issue. So as we've seen, it's not just growing in demand for US companies, it's also in Europe and Asian markets as well. And do we think it's feasible to create metrics? And as Joe pointed out, companies are already developing metrics to report to. And so we think that getting alignment on what makes sense is feasible based on where the market is at. And so we initiated standard setting for 2 industries, meat, poultry, dairy, and food retailers back in May. And our standards board is going to be voting on adding in processed foods into that standard setting project in October, next Friday. So if you're interested, I recommend registering for the board meeting and listening in. But that is our plan to evaluate processed food companies as well. Next slide. So just to give a little bit of background, the ideal outcome is that we'll determine how industry standards could be updated to improve the decision usefulness by looking at if there's a way to improve or add in disclosure topics or add in new metrics. So I will say the standards already include metrics related to things like supply chain or GHG emissions, but what we heard from the market is that metrics specifically related to alternative products and alternative product strategy would be helpful. And so that's really what we're evaluating. And I'll also say the goal of this project is not to create a new industry standard for alternative product companies specifically. It's our view that those companies can already report to the processed food standard. So that standard already highlights what's likely to be material ESG issues, no matter what type of product you're making. But there could be an opportunity to add in a metric, say, related around protein diversification for any company across those 3 industries. Next slide. So just a little bit on next steps. We are going to be opening a consultation period in October with the goal of sort of talking about what those disclosure topics and metrics should look like. And all of those consultations will be, they won't be publicly available. Your input, that happens later. So if you're interested, please reach out. And then we'll release exposure drafts of proposed changes to the industry standards, hopefully sometime in 2022 based on that market input. And you can visit the project page to subscribe to updates, and also reach out to me if you would like to be involved in developing those metrics. Certainly welcome your feedback. As I said, that's a very important part of our standard setting process. And that's it for me. So thank you so much for joining. I hope that was helpful and looking forward to speaking with some of you shortly.
Thank you, Devon. All right, I think we're towards the end of our panel / presentation. Now we're going to talk about resources and how to stay engaged. So you can check out this session additional information section where you can find the GFI blog post, Cultivating a Better Future with Impact Investing, the life cycle assessment study of cultivated meat, as well as the plant-based meat environmental fact sheet. And then how to stay involved. Next slide, please. You can join GFI's investors directory. You can see how to do that there, and then sign up for the Alternative Protein Opportunity newsletter, both of those in the GFI website. And of course, always explore alternative protein deals in GFI's fundraising database. So some amazing resources in the GFI's website. You have seen a lot of the LinkedIn and email content of the presenters, as well as the panelists. And so as of this, we're closing our panel presentation. Thank you so much to the panelists, to the presenters, and then of course to you, the audience, for joining us. I've also dropped my LinkedIn in case you want to get connected and chat further. Otherwise, thank you so much to everybody, and for GFI for holding a conference that is so important and so relevant right now, and a panel that was really interesting. I was very intrigued, and you can see in the chat all my reactions to all the things that we heard today. So have a good rest of conference, everybody, and bye. See you later.